Welcome to this webinar. We will be going over real estate investing. This is the first part of a three-part webinar series. A couple of announcements. If you have any questions, you can type them into the chat. If I don't answer them during the course of the presentation, I will get to it at the end. This webinar is being recorded and it will be shared with you. With that, let's get started. A note of disclaimer, this webinar is free of charge. You're not expected to be a client of Empower Financial, either now or in the future. The information provided here is generic. It's not specific individual advice. Please consult your financial advisor or tax professional for your specific situation. The information provided here is drawn on various sources from the internet. While we've tried our best to make sure that the information is accurate and up to date, we cannot guarantee the accuracy of all the information. And any investment products or specific examples used are for illustration purpose only and not advice. The agenda for today, we will start off with an introduction. We'll go over the basics of real estate investing, what exactly it is, what are salient features, and how do you measure the returns on real estate investments. And then we'll look at the primary home and vacation homes, because that's what most of us are familiar with. And we'll view that in terms of, are they really real estate investments or not, and how do they differ? And then we'll move on to some frequently asked questions that I get vis-a-vis real estate investments and home purchase. And then we'll open it up for Q&A. So this webinar is brought to you by Empower Financial. We are an advice-only financial advisory. And what that means is we do not manage your assets, but we offer comprehensive financial planning advice and help you manage your investments. We provide comprehensive financial advice. That means all aspects of financial planning, including investment advice, budgeting, cash flow, retirement planning, tax planning, estate planning, and the whole gamut. When it comes to this webinar, real estate investing is a vast and complicated topic. And there are many actors like institutional investors, construction professionals, mortgage industry, but we will be looking at real estate investing through the lens of an average retail investor, which is you and I. And as I said earlier, this is the first one in a three-part series where we're going to go over the basics and primary home. In the next one, next part on April 6th, a week from now, we will be going over directly owned or active real estate investing. And then on 2 Thursdays from now, April 13th, we'll be going over passive real estate investing, where you are giving your money to a sponsor or an investment manager who does the investment for you, and in return for that, he or she takes some profit and a fee. And in broadly speaking, there are two major ways to invest in real estate. One is through credit, where you give somebody the money and they do it and they are taking the risk on. And otherwise, the other option is through equity, or direct ownership, where you are liable, you have skin in the game. So we will be exploring all the three parts will be focused solely on through equity, where you are the investor yourself. And I've tried to make this presentation accessible by keeping the information fairly generic and high level. All right, with that, let's start off with the basics. What is real estate investing? Let's define this because it's important to know what goes into it and what's not a part of it. So the definition here I've used is real estate investing is an investing strategy that uses the purchase, ownership, rental, management, and sale of real estate property for profit. The terms that I've highlighted, which warrant a little more attention. The first one is it's a strategy. So hope is not a strategy. You have to have a plan that you can execute on to realize a profit. That's what investing is all about. The next thing is it's real estate property, which means that it's backed by real physical assets, land and buildings. And this fact has a lot of ramifications, and we'll explore that more shortly. And then finally, you do it for a financial gain, for profit. All this really means is that you need to have a strategy in place, and buying a property just because you see potential in it or you think an area is going to boom, that doesn't always give you winners. What really gives you a winner is a sound plan and your ability to execute on the plan. And what are some of the salient features of investing? What are some of the highlight, and how does this look different than other forms of investment? Well, firstly, it's backed by real physical assets, and it's not movable. And this has a lot of ramifications. So you're bound to the local laws and policies like building laws, tenant protection laws, taxation, local weather, climate. All these have an impact. Unlike other investments, like a small business or a financial investment, if you're not happy, you can move to a different geography, you can move to a different location. With real estate, that's not really possible. The next factor, or the next salient feature, is its valuation depends on highly subjective factors. And we know this. Real estate is hyper local. Everything goes into it. There are a lot of factors like what street it's on, what block, what state. So there's a lot of highly subjective factors which go in, and it really depends on who's doing the evaluation and what is the target audience, what is the plan. So that is closely linked with the valuation that they come up with. The next feature is that its leverage is extremely common, unlike a small business or like a startup, where the capital comes in mostly in form of equity, whereas here it's mortgage. So an entity, usually a bank or a private lender, loans you a significant chunk of money to make an investment. And leverage is extremely common. It is very prevalent, and there are different types of loans, different types of, there's quite a bit of competition and well-regulated industry around leverage for real estate. And the next thing is high transaction costs. What this really means is that you can buy a piece of stock for a fraction of a stock, or a stock for literally $0. But when it comes to real estate, exchanging hands, ownership transfers are expensive. There are many actors, there are brokers, and it's quite an involved process. The real estate investments are illiquid, and what that means is they're not readily fungible. Yes, there's a market, but it often takes weeks or months to close the deal. So it's not really fungible. It is capital intensive, and what we're talking about is hundreds of thousands of dollars all the way to millions of dollars. Unlike stocks, you can't buy real estate for $100. And it's also management intensive because it involves physical assets. Management tends to be hands-on, which means that it's a very niche and kind of area in its own. So with all this, what are the reasons why one should consider investing in real estate? The first thing is, it is at the core of human activity and development. Real estate is all around us. The house we live in, the offices that we work in, the hospitals that we go to, schools, shopping centers, hotels. So it's really fundamental to our existence as a society. And you're investing in something that's really core to our development. So you can rest assured that there is demand for it. Of course, not all real estate is equal, but it is finite. There is only so much land, and there's only so many buildings you can build on the land that we have. So it's bound to be in demand. So these are some compelling reasons to think about real estate investments. Also, historically, real estate investments have had low correlation with stock markets, and that's good for you as an investor. You don't want all your investments going up and down at the same time, and having something that's not correlated with stock market is a good diversification tool. Along similar lines, it's also less volatile real estate than stock market, and volatility might be okay, or even it might work in your favor when you're in the accumulation phase and you're saving a lot. But as you move to closer to retirement, when you start depending on your investments, too much volatility can be unsettling. So you want something to dampen that volatility, and real estate does a great job of that. Business cycles and real estate cycles tend to be different, so they move up and down in different times, and there is less volatile. So all that is great for hedging the volatility in your portfolio. There's also a well-defined capital market for real estate investing. What this means is that there are various types of loans, traditional loans, bridge loans, construction loans. It's a regulated space. Compare this with something like buying a piece of art or royalties, where the market is not as established. The space is not as mature. It's very niche. So having a very mature space, it and a lot of financial infrastructure that works in your favor. There are also massive tax benefits to real estate investing, and what this really means is that you can invest in real estate and reap the benefits over a long period of time, and when it is tax advantaged. What this really means is things like depreciation and other expenses reduce your taxable income. So while you're invested, your tax footprint is low. And when it comes to selling an asset or exiting an asset, you have options to defer the capital gain or minimize that capital gain to something called 1031 exchange. And these are topics that I will be going a lot more detail into in the subsequent chapters of this webinar. But for now, just know that it's compelling tax advantage features for real estate investing. And there's equally strong reasons why one should not invest in real estate. It's not for everybody, and it's good to know why you might not want to do it, and stick to stocks and bonds and other familiar investments. The first one is high barrier for entry. And what this means is that because it's capital intensive, you'll have to put up quite a bit of sum of money. So it might not be the best if you're just starting out your career or starting your savings. Even passive investing, which you do through syndicates or other sponsors, they have high minimums and high investor qualifications. So it's not really for everybody. This is something to keep in mind. The next point is the real estate market is not as efficient as the stock market. What I mean by this is that excuse me, since real estate is very local and the valuation is somewhat subjective, there can be an asymmetry of information. If you're familiar with a particular building or a particular street or an area, you might have some advantages that somebody else might not have. And this can work to your advantage if you're familiar and if you have more information, and it will work against you if you don't have that. And when it comes to regulation, stock markets, public companies are a lot more strictly regulated, well regulated. They have stringent reporting requirements, and investments in those vehicles tend to be a lot more regulated. But when it comes to real estate investments, yes, there is regulation, but it's not as mature. And if you are not on top of your due diligence, that is understanding everything about your purchase, then there's a tendency to kind of take on a new risk that you haven't uncovered during your due diligence. And often litigation is the only recourse. It's an involved process. The other point is it's less diverse than stocks. Consider stocks if you're buying something like S&P 500 or the whole stock market index, you're getting a massive diversification there, because these are companies spread throughout the world. They have boards, they have a lot of oversight. So you're investing in something that's really diverse at a low barrier for entry. With real estate, you're putting all your eggs in one basket, so to speak. And if there are problems, then it will be difficult to rectify them. The other point is successful real estate investing really needs a team that you can trust and that can deliver for you. It has a team of brokers, contractors, lenders, lawyers, and it takes time to get to know these people. It takes time to put together a good team which can deliver, and this is not easy. So yeah, these are some of the reasons why you want to think about real estate investing long and hard before jumping in. Um, and the next point is about how do we, okay, so you know what you're getting into. What do you want out of the investment? Like, how do you measure the returns? And that there are a few ways in which you can slice and dice. This slide is not this important for this particular webinar. We'll be using this information a lot more in parts 2 and 3, where we are actually going to be quantifying some of the investments. So for the first one is equity multiple. Let's say you put $100,000 and you get back $200,000. So you have an equity multiple of 2x. So you've whatever you put, it's doubled. And this particular factor does not take time value of money into consideration. It doesn't matter if the 200,000 came back to you in a year or 2 years or 3 years, it still says 2x. And this particular metric is used in certain kinds of investments, let's say ground up investments where there's no regular cash flow, or in flips, again, where there's no regular cash flow. Equity multiple is a good metric to use. What happens when there is regular cash flow, like a rent collected and you get that rent after paying off the expenses? Then you could use something like an IRR, which is internal rate of return. And this metric factors in the time value of money to the date. It's very precise, and you need an Excel or spreadsheet to calculate this value. And it's expressed in terms of percentage. And if you want a more hand wavy but similar metric, you can use something called cash on cash. And what's cash on cash? It's basically similar to IRR, but it's not that precise. You don't need a spreadsheet to calculate it. Let's say you invest 100,000 and you get back 12,000 after all the expenses in the first year. It doesn't matter whether it was returned in month 1 or month 6 or month 12. It's just the first year returned you 12,000. Then you say it's 12% cash on cash on my investment. So it's less precise, and it's more easy to parse cash on cash, and it's used fairly commonly. All of these figures are after expenses and fees. It's the net received by you, the investor, at the end of the day. So we've looked at some basics of real estate investing and how do you measure returns. Now let's move our attention to primary homes, which most of us are familiar with. We are thinking about buying a home, or we have a home. We might be thinking about getting a second home or vacation home. So the reason I want to kind of start off here is because something that we are all familiar with. And the first question that we want to ask ourselves is primary home a real estate investment? Why is this an important question? Because for most of us, primary home is one of the biggest and most important purchases we make in our life. And the reason why this question is important is because we want to approach it with a broad understanding of the real estate landscape and how primary home compares to traditional real estate investments. Armed with that knowledge, we can make better decisions, financial decisions related to our primary home. So this next slide is very dense. There's no need to parse the entire thing or understand the whole thing. The main difference between traditional real estate investment and primary home is that when you're buying a primary home, qualitative factors play a bigger role. You're looking at the locality, the community, whether it's got good schools, is it close to employment? Those are the qualitative factors that come into play. And there are some financial factors like, can you afford the home, and what's the monthly payment? Do you have enough down payment? Those are some of the financial considerations, but they're a lot less. Compare that to a traditional investment where you're really looking at what is the plan, how do I maximize profit? So you're wearing a completely different hat. The other big factor of difference, an area where primary homes differ from real estate investments, are in the area of expenses. Let's say a faucet breaks down in your primary home, in your home, and you have to replace it. That is not a deductible expense. You will be paying out of pocket, and that's the end of the story. Whereas with a traditional real estate investments, if there is a maintenance like a faucet that breaks or HVAC system that needs to be replaced, you can write it off against the income that you've made. So it offsets the income that you've made. So that's a huge tax advantage when it comes to real estate investments. Primary home is, by and large, when you're staying in it, it's a money losing venture, as in you put more money towards it for the upkeep, for furnishing, for property taxes. Whereas in real estate investments, yes, you are have expenses, but they're offsetting your rental income. That's a huge advantage. One aspect where they are similar is that both a primary home and real estate investment, you can deduct mortgage interest. Of course, with the primary home, the limit is 750,000. With traditional real estate investment, there is no limit. So that's one area where it's similar. Having kind of said all this, they are not traditional investments, but they have a lot of reasons to be considered primary home ownership. The first thing is homes tend to appreciate in value over a long period of time. So there is some financial gain there if and when there is an exit from your homeownership. And there are public policies which are designed to encourage and protect homeownership. For example, there's homestead exemption, where if there's a credit charge against you, and either because of bankruptcy or something, then a creditor can't come after your home, primary home. And then there's foreclosure protection in case you default. Of course, this is within limit. And there are other things like federal aid for disaster affected homes. Mortgage industry is geared towards like encouraging home ownership. So all these are great reasons why you might want to consider home ownership. It does act as a fairly solid tool to build wealth over a long period of time. And the principal pay down that you do as a part of your mortgage payment every month, it acts as a forcing function for you to save. It's a good habit to build, to save money. So it encourages you to do that. So all this means that there is value in primary homeownership, but it's also important to approach it with the right attitude that this is something that I will be paying towards before I realize any benefit, financial benefit right away. And there are some ways in which you can maximize your bang for the buck while buying a primary home by wearing an investor's hat. And what I've listed here is different ways in which you can kind of enhance the value of your home, primary home. And they're in kind of order of difficulty here. So the first thing you can do is buy a home that needs some work, like a paint job, landscaping, updating kitchens and bathrooms. By buying a fully finished, ready to move in home, you're paying for the work that's already been done. But if you're willing to do it yourself, then you can save some money and add value to your purchase. Another way you can add value to your purchase is by adding square footage to your home. Square footage is one of the strong factors in pricing of a home. So anytime you add square footage, you're adding significant amount of value, like adding an extra room, that really enhances the value. You can go a step further and add a complete different unit, where it will not only add value to the home, but you can also generate cash flow by generating rental income every month. That's another way. And this last point about cash out refinancing or taking a HELOC, it's not applicable to everybody. It's not suitable for everybody, but you have a lot of equity because you've done significant amount of work or you've stayed in your home for like a long time. Then it might make sense in certain cases to do a cash out refinance or take a HELOC and pull out some of the money, invest it in your next home or a different investment. That way you're realizing some of the financial benefits of your primary home. The next question that comes up is, what about a vacation home or a second home? Is that an investment? And this is where it gets a little more complicated, especially with a vacation home. It really depends on the number of days in a year that you rent it out for. Very quickly, if you really are using it primarily as a residence, where you are using it for your personal benefit and use, and not renting it a whole lot, less than 14 days, then it acts as a personal residence. And all the things that we spoke about primary home is pretty much applicable to your second home or your vacation home as well. On the other end of the spectrum, on the right side here, what happens if you are treating this mostly as a rental? You're staying in this home for less than 14 days in a year. It's almost always rented out. Then it acts as a rental. And then it looks a lot more like a directly owned real estate investment, which we're going to cover in the next episode of this webinar series. And in between these two extremes, it acts as a part rental, part residence, and it gets a lot more hairy in terms of taxes. You have to maintain records of when you stayed, when it was rented out. There are certain deductions allowed, and certain deductions not allowed. So it's quite involved. So with that, one of the first questions I want to answer is, should I buy a vacation rental? That's a common question. And the answer really is, going back to the slide, it depends. If you're looking at it primarily for your benefit and enjoyment, then wear that hat more fully and look at it as something that you want for yourself. So and then affordability becomes the question: how often will you go? Will you really use it? What type of space you need? Which area or which vacation destination you need? So those are the considerations. On the other hand, if you're looking at it as mostly a rental, then wear that hat more fully and look at how many nights will it be occupied? What is the competition around the area? Is it a year-round destination, or is it only like a seasonal destination? All those become the consideration, and you want to consider more financial aspects of the income and the expenses and the upkeep than you would if you were using it for personal enjoyment and benefit. So that's the first question. Second home, should I buy a second home? That's another question that around homes. Well, the answer is similar to the first one, in that you want to look at what is your goal. Is it that you'll be using it sometime, or is it purely as an investment where you're looking at renting it out? Then it looks more like a directly owned real estate, which we will be covering in the next episode. So the next question that comes up is, when is a good time, or is now a good time to buy my primary home? And the answer to this is fairly simple and fairly it doesn't change over time. It is, when you're ready to buy a home, you will know it, and that's the right time. What does that mean? That means that you are intending to live in that area for a significant amount of time, at least 5 to 10 years. You have a fairly stable financial life where you can make monthly payments, where you can afford a down payment. And you want a space for yourself that you want to create, and you want to have own this. You want to design your own space and so on. So those are the reasons why you want to buy a home. And then the question really becomes, is now the right time? that becomes less about timing the market rather than like, are you ready for that? What comes with home ownership? So that's the primary question that you want to ask. Another question that we get is, should I sell my starter home when I move up? Let's say because of a better school district, or I move from a condo to a single family home. Should I sell? And this is an interesting question. And one of the things that I tell people is that it's a good way to actually become a landlord and experience what it means to be a landlord, what it means to collect rents, or what it means to answer, like, your tenant asking something's broken, like, I want it fixed, what it means to file taxes as a landlord. So it gives you a good experience in real estate investing without, like, you've already kind of made that entry into real estate ownership. The barrier of entry is reduced for you, so it's a good way to experience being a landlord and getting some experience as a real estate investor. So if you can afford it, you might want to try to hold on to your property and see how it works out as an investment. And you can always do those things that we spoke earlier: add square footage, add an ADU, or put significant amount of work in it before selling it. So that is something you want to consider before selling your uh, starter home that you just moved out of. With that, I'll open up for questions. Well, actually, I just want to give you a preview of what's coming up next. In part 2, we will talk about directly owned real estate. We'll go over some nitty-gritties, like the different asset classes, different types of investment. Again, we'll revisit how to measure returns, underwriting, how is that done, what are the tax ramifications of owning real estate as investment, and some of the pros and cons. Is this for me? Is this for, who's this right for? And we'll answer those questions. In part 3, we'll be looking at passive real estate investing through REITs and public private placements. And again, the same questions there. How does it work? What is the deal structure? How does somebody who's managing my investment, how are they compensated? Some of the tax ramifications of passive real estate. And again, pros and cons. Is this for me? Like, do these pros work for me, or do I want to look at other options for real estate investing? So we'll cover this. With that, we'll open up for Q&A. And this is how you reach me, Praveen at Empower Financial. We are happy to get on the phone or Zoom call and chat about your real estate purchase or investment, and walk you through some of the advantages or disadvantages, or answer any questions you might have. All right. So looks like there are no questions. We hope to see you at the next webinar, which is a week from now, and we'll be talking about directly owned real estate. Thank you. Thanks for your time.